Welcome to our deep dive on the building blocks of risk management. Understanding risk is kind of like having a superpower in any field, really, wouldn't you say?
Absolutely.
We've got some really fascinating material here, stuff that really digs deep into how we measure and manage risk. And,
Right.
and it gets me thinking, have you ever stopped to think about how companies or even just individuals actually put a number on risk?
It's a great question and it really gets at a crucial point. We don't just avoid risk, right? It's something we can quantify, manage, and frankly, something we need to get more comfortable with. I think what people often miss is that risk is tied to the possibility of a reward.
Okay.
So the bigger the potential reward, the greater the risk you often have to take.
Okay, that makes sense. If someone offers you a chance to invest in a brand new startup, the potential payoff could be huge, but then there's also a chance you could lose everything.
Exactly. And that range of possible outcomes, that variability, that's really at the heart of how we define risk. The wider that range is, the higher the risk.
So it's not just about whether something bad could happen. It's about how unpredictable the outcome is in general.
You got it. And that leads us to a distinction that a lot of people kind of get mixed up.
Hmm.
Managing risk versus taking risks.
Hmm. Yeah, those sound similar, but I'm sure there's a difference. What is it?
So think about planning a road trip across the country.
Okay.
Managing risk is like making sure your car is all tuned up, right? You got a spare tire, good maps.
Yeah.
You're not eliminating the possibility of a breakdown or detours, but you're reducing the chances of those things happening and their impact if they do.
All right.
Taking a risk might be like choosing a scenic mountain route,
Right.
right? Instead of a boring but safer highway,
Right.
you're accepting a higher level of risk for a potentially bigger reward.
Yeah, I get it. So managing risk is like being prepared, minimizing those potential losses.
Mhm.
While taking risks is like going after those rewards, knowing that things could go wrong.
Exactly. And they're both important in different situations.
Yeah.
Risk management helps protect us from those really bad outcomes. But taking risks, that's what drives innovation and progress, you know?
Okay, that raises another question for me. If risk is a part of everything we do, how do we even go about managing it? Systematically, I mean.
That's where this structured risk management process comes in. It's this framework helps us identify, analyze, and manage these potential risks in a consistent way. It's not about getting rid of risk altogether. It's about making these informed decisions about, how much risk we can handle.
Okay, I'm following you. So what are the key steps in this process?
Well, it starts by figuring out what could go wrong, right?
Right.
Whether it's a business, personal project, or even daily life. And then once we know what those potential issues are, we measure them.
Mm-hmm.
How likely are they? What would the consequences be? That gives us a sense of how big each risk really is.
So it's not just what could go wrong, it's also how likely it is and how bad it would be.
Yeah. And once you've got a handle on those two things, you can start looking at ways to manage those risks.
Okay.
Maybe take steps to prevent them altogether, or reduce the impact, or even transfer that risk to someone else, like insurance.
Makes sense. It's
Yeah.
not just reacting when problems happen, but trying to see them coming and putting things in place beforehand.
Exactly. And that final step in the process, it's like regularly checking up on how well your risk management is working, right? Are your strategies working? Or do you need to make changes?
Yeah,
The
yeah.
world changes constantly, and the risks we face change right along with it.
This is making me think about expected versus unexpected loss.
Mm,
It seems like those two ideas are important when we're talking about managing risk.
You're right. Those are key concepts. Let's say you're launching a new product. You know there will be marketing costs, production, maybe some returns. Those are your expected losses. They're part of your plan.
Yeah.
But then there's the unexpected loss, like maybe a competitor launches a similar product at a lower price, or consumer tastes suddenly change.
So expected losses are the costs we can plan for, and unexpected losses are those curveballs.
Exactly. We can't always predict them, but having plans and reserves can help you when those unexpected things happen.
Now I'm thinking about all the different types of risk out there. Seems like a lot to keep track of.
You're right, there are a lot. Understanding the differences is important.
Yeah.
Broadly speaking, we can group them like this: market risk, credit risk, liquidity risk, operational risk, then legal and regulatory risk, business risk, strategic risk, reputation risk, and systemic risk.
Wow, that's a lot.
Yeah.
Let's start with market risk, since we were just talking about investments. What exactly is market risk?
Market risk is all about the ups and downs of financial markets. It's the risk that the value of your assets, like stocks or bonds, could change because of things like interest rates, currency exchange rates, commodity prices, or just general market sentiment.
So like if I buy stock in a company and then the market crashes, that's market risk.
That's right. Or let's say you have money in a savings account earning a fixed interest rate. If inflation suddenly jumps up, your money might not be worth as much. That's another example of market risk.
Makes sense. What about credit risk then? How's that different?
Credit risk is the chance that someone who owes you money won't pay it back. It's the risk of default. It could be a friend, a customer, or even a big corporation issuing bonds you invest in.
So if I lend a friend money to start a business and it fails, that's credit risk.
Exactly. And the risk depends on the borrower, their creditworthiness. Are they financially stable? Do they have a good track record of paying back debts? The more reliable the borrower, the less risky it is.
Okay, I see.
Yeah.
Understanding these different types of risk can help make smarter choices, right?
Absolutely.
Now, what about liquidity risk? That one sounds a little less familiar.
Liquidity risk is the risk that you won't be able to turn your assets into cash quickly without losing money. Imagine you own a rare antique car and suddenly need to sell it quickly to cover some unexpected cost. If you can't find a buyer willing to pay a fair price on short notice, that's liquidity risk.
So it's not just about having assets, it's about being able to access their value quickly when you need it.
Exactly. And this can be a big problem during a financial crisis, where buyers disappear and prices drop sharply.
Okay, so we've got market, credit, and liquidity risk. What's next?
Let's look at operational risk next. This one's a broad category. It covers risks that come from internal processes, systems, and people within an organization. It's basically the root of things going wrong in your day-to-day operations.
So, like a bank employee accidentally transferring $1 million to the wrong account, or a software bug crashes a company's website, those are operational risks.
Yep, those are great examples, and it can show up in lots of ways. Simple human error, complex system failures, natural disasters, you name it.
It sounds like it's almost impossible to avoid with how complex organizations are these days.
True, it's really hard to get rid of it completely, but companies can try to reduce it by having strong internal controls, using reliable technology, and training employees on best practices.
Right, makes sense. What about legal and regulatory risk? How does that fit in?
Legal and regulatory risk comes from the possibility of lawsuits, judgments, regulatory fines, or changes in laws and regulations. It's the risk that a company's actions could break the rules, leading to legal or financial trouble.
So like a drug company getting sued for false advertising or new environmental regulations increasing costs for a manufacturer, those are legal and regulatory risks.
Exactly. And managing this type of risk means staying up to date on the legal and regulatory landscape, having good compliance programs in place, and getting expert legal help when you need it.
It seems like this kind of risk is extra challenging because the rules can change out of nowhere, right?
Yeah, absolutely. Staying on top of legal and regulatory changes is key to managing this type of risk.
Okay, we've covered a lot already. Think we can squeeze in one more type of risk before we wrap up this part.
Sure, let's talk about business risk. This one is kind of a general term for risks tied to running a business. It covers stuff like market demand, competition, pricing, costs of materials, and even changes in what customers want.
So if a company puts out a new product and it flops because no one wants to buy it, that's business risk.
Right. Or if a company's profit margins shrink because raw material prices shoot up, that's business risk too. Basically, it's the risk that a company's core business model won't be as profitable as they hoped.
Wow, we've gone through a lot of different types of risk in this part of our deep dive. Can you give us a quick summary before we move on?
Of course. We started by defining risk, that range of possible outcomes,
Hmm.
and talked about the difference between managing risk and actually taking risks.
Mm.
Then we discussed the four main steps in risk management: identifying, measuring, managing, and evaluating those risks. And finally, we looked at several big categories of risk: market risk, credit risk, liquidity risk, operational risk, legal and regulatory risk, and even touched on business risk.
Yeah, great overview.
In the next part, we'll go deeper into the remaining types of risk: strategic risk, reputation risk, and systemic risk.
Looking forward to it.
Welcome back to our deep dive into the building blocks of risk management. Last time, we went over several key categories of risk,
Right.
and I want to jump into some of the remaining types now. Let's start with strategic risk.
Okay, strategic risk. What exactly does that cover?
So, a strategic risk, it's the risk that a company's long-term decisions, like their strategic choices, might not work out the way they planned. It's like their big plan for the future could go wrong because of all sorts of things, stuff they can control and stuff they can't.
So it's about those really big decisions, the ones
Mhm.
that can make or break a company, right?
Exactly. Think of it like this. A company decides to invest a ton of money in some new technology, right? They think it's going to revolutionize their industry.
Yeah.
But there's a risk, right? Maybe the technology doesn't work like they thought. Maybe it becomes outdated really fast, or a competitor comes up with something even better.
Right. So it's not just about those everyday operational risks. It's about taking big swings, betting on the future.
Exactly. Strategic risk is often tied to things like, what the competition is doing, how technology is changing, what consumers want, and even global events like political changes.
It sounds like to deal with strategic risk, you need to understand not just your own company really well, but also the whole world around you.
Yeah, you really do. And it often means making tough calls, balancing the potential upside with all the unknowns of the future.
Okay, now I'm curious about reputation risk. It seems like we hear that term all the time these days. How's that different from strategic risk?
Reputation risk is the risk that a company's image could be damaged, leading to, people not trusting them anymore, customers leaving, and eventually hurting their financial performance. It's about how the public sees the company, its stakeholders, everyone.
So it's not just what a company does, it's also about how other people see those actions, right?
That's it. A company could be doing everything by the book internally, but if they mess up or there's a scandal or even just bad press, their reputation could be seriously hurt.
Yeah. In today's world where everyone's connected, it feels like reputation risk is a bigger deal than ever.
It really is. Social media, the news cycle, they can make information about a company, good or bad, spread incredibly fast.
Right.
Like a tweet or an online review, it can go viral and do serious damage to a company's image.
So it's not just about avoiding those scandals or big problems, it's about actively managing your online presence, building that good reputation over time.
Absolutely. It's about being open, engaging with people authentically, and addressing concerns head on. It's about building trust so that if problems do happen, you're more likely to weather the storm.
Now, let's talk about systemic risk. This one sounds kind of scary.
Systemic risk, yeah. That's
Yeah.
the risk that if one entity fails, usually a financial institution, it could trigger a chain reaction, a cascade of failures throughout the whole system.
Okay.
That leads to widespread financial instability and disrupts the economy.
So like dominoes, right? One falls, they all fall.
Perfect analogy.
Yeah.
Think about how connected the global financial system is. Banks lend to each other, invest in each other, use all these complex financial instruments and transactions.
Right.
If a big institution goes down, it could create this ripple effect that spreads throughout the whole system, causing other institutions to fail too.
That sounds like a nightmare.
It can be. That's why managing systemic risk is so important for regulators and policymakers.
Yeah.
They try to put safeguards and rules in place to prevent those too big to fail situations and to keep the whole financial system stable.
So we've covered a lot, from small operational hiccups to these huge systemic collapses.
It is a lot, right? Risk is everywhere, and it affects every part of business and life.
Before we move on, can we circle back to something you mentioned before? This risk appetite thing.
Sure, happy to.
What does that mean exactly?
Risk appetite is basically how much risk a company is willing to take on to reach their goals. It's a choice they make about how much risk they're comfortable with.
So it's like a company's personality when it comes to risk.
Yeah.
Some are daredevils, some are more cautious.
Exactly. And just like with people, a company's risk appetite is shaped by all sorts of factors: their industry, financial situation, their culture, even the personalities of their leaders.
It seems like figuring out your risk appetite is a crucial first step in developing a good risk management strategy.
It really is. It's like setting boundaries, figuring out how much risk is okay, and then making sure you have ways to stay within those boundaries.
Looking back at all the types of risk we talked about: market, credit, liquidity, operational, legal, regulatory, business, strategic, reputation, and systemic.
It is a long list.
Are there any common things that run through all of them? Any basic principles that could help us manage all these risks better?
That's a great point. It shows how important it is to have a big picture view of risk management.
Yeah.
While the specific strategies for each type of risk will be different, there are some fundamental principles that apply across the board.
Okay, I'm listening. What are these universal principles of risk management?
One of the most important ones is to be proactive. Don't wait for a crisis to hit before you start thinking about risk.
Right.
Instead, build this culture where everyone's aware of risk, make risk management part of how you make decisions, and try to anticipate those challenges before they become big problems.
So it's like having a fire extinguisher in your kitchen before a grease fire starts.
Exactly. Being proactive means figuring out potential risks early, figuring out how likely they are and how bad they could be, and then putting strategies in place to deal with them before they blow up into something major.
What else is important?
Another big one, get everyone involved. Risk management isn't just for the risk management team, it should be part of how the whole organization operates.
Mm.
Everyone, from the CEO down to the entry-level folks, should know about the risks and feel comfortable reporting them and helping to manage them.
So you're saying create an environment where people feel okay speaking up about potential problems and are encouraged to think about risk in their everyday work.
That's it. When everyone's involved and feels like they own it, you're way more likely to spot those risks early and deal with them effectively.
This is making me realize that risk management isn't just about avoiding bad stuff. It's also about creating opportunities.
That's a great point. When you manage risk well, it can actually help organizations reach their goals more effectively. It gives them a framework for making smarter choices and navigating those tricky situations. It's about balancing risk and reward, not just trying to eliminate risk completely.
I like that perspective. So it's not about being frozen by fear, but about understanding that there are always unknowns and using that to your advantage.
Well put. That's what good risk management is all about. Understanding that risk is part of life and business and coming up with ways to deal with it effectively.
This has been a really insightful look at the different types of risk and how to manage them.
Thanks.
As we wrap up this part, are there any key things you want our listeners to remember?
I'd say the most important thing is that risk is complex and it's everywhere. We can't just ignore it or get rid of it entirely.
Right.
We need to really understand the different types of risk, be proactive, have a holistic view, and make risk management part of how we make decisions at every level.
Yeah.
If we do that, we can not only protect ourselves from those potential losses, but also find new opportunities for growth and innovation.
That's a great takeaway. Risk management isn't just about playing defense. It's about setting yourself up for success by understanding and working with that complex world of risk.
Exactly. And as we move into a future that's full of uncertainty and interconnectedness, mastering these risk management principles is going to be more valuable than ever.
Welcome back to the deep dive. In parts 1 and 2, we really dug into the world of risk. We talked about all sorts of things.
Great.
Market ups and downs, credit defaults, operational stuff,
Yeah.
strategic risk, reputation, the whole works.
Yeah.
Now, for this last part, let's shift gears a bit. We've got a good understanding of risk now, but how do we actually manage it? How do we take all this knowledge and put it into practice?
Well, that's the million-dollar question, isn't it? And as you might imagine, there's no easy answer. It all depends.
Yeah.
It depends on the type of risk, the situation, the organization, their risk appetite, all those things we talked about.
Okay.
But even with all that complexity, there are some basic strategies and tools we can use. Those can help guide us.
Okay, I'm ready to hear about these strategies and tools. Where do we start?
Let's start with the 4 main ways to deal with risk: avoidance, mitigation, transfer, and acceptance.
Okay.
Each approach has its own way of handling risk, so knowing when to use which one is key.
All right, break it down for me. First up, risk avoidance. Seems pretty simple, right? If something's too risky, just don't do it.
You got it. Avoidance is basically saying, too risky, not going to do it. You're steering clear of anything that has more risk than you're willing to accept.
So like, if I'm scared of heights, I'm not going to go skydiving. That's avoidance.
Right. Perfect example. But it's not always possible or even a good idea to avoid all risks. Sometimes, if you avoid risk completely, you miss out on chances to grow or innovate.
That makes sense. Can't always play it safe if you want to achieve big things. So what about mitigation? How's that different?
Mitigation is about taking action to make a potential loss less likely or less severe if it does happen. Instead of avoiding the activity altogether, you put things in place to minimize the damage.
Okay, so going back to skydiving. If I really wanted to try it, even though I'm scared, I could take lessons from an expert, use the best equipment, and choose a company with a really good safety record.
Exactly. That's mitigation. You know skydiving is risky, but you're doing what you can to make it safer.
So it's all about being prepared and having safety nets.
Right. And there are lots of ways to do it, like putting in security systems to prevent theft or diversifying your investments so you're not so exposed to market swings.
Got it. Okay, what about risk transfer? That one sounds interesting.
Transfer is basically shifting the financial burden of a potential loss to someone else. This is where insurance comes in.
Oh, so like when I buy car insurance.
Exactly. You
Yeah,
pay the insurance company, and they take on the financial responsibility if you have an accident. They're taking the risk for you in exchange for your premiums.
makes sense. Are there other ways to transfer risk besides insurance?
Sure, sometimes you can outsource certain parts of your business. Like if a company has another company handle their IT, they're transferring some of those cybersecurity risks to that other company.
So it's like finding someone who's better at handling certain risk or more willing to take it on.
That's the idea. But remember, even when you transfer risk, it doesn't disappear completely. You're just shifting the financial part. You still need to make sure the other party is reliable and can actually handle it.
Okay, so we've got avoidance, mitigation, transfer.
Hmm.
What about acceptance? You mentioned that one earlier.
Acceptance is when you know there's some risk and you decide to just live with it.
Okay.
It's knowing that the cost of trying to reduce or transfer that risk might be more than it's worth.
So like, I know there's a chance of rain if I go for a walk, but I decide to go anyway because I enjoy walking and I'm okay with that small risk.
Exactly. You often see risk acceptance when the potential losses are pretty small and trying to prevent them would be expensive or complicated.
It seems like picking the right approach, whether it's avoiding, mitigating, transferring, or accepting, involves really weighing the pros and cons of each one.
You got it. There's no one right answer. The best way to handle it depends on the situation and how much risk the organization is willing to take on.
You know, thinking about all the risks we've discussed, I'm realizing that some are easier to measure than others. Like, market risk seems easier to quantify than something like reputation risk.
That's a good point. Measuring risk is really important. It helps us figure out how big those potential losses could be and compare different risks. But you're right, some are easier to measure than others.
So how do we go about measuring risk, especially those fuzzy ones like reputation or strategic risk?
Well, there are different tools and techniques, and the best one often depends on what you're trying to measure.
Okay.
For those quantifiable risks, like market risk, we can use statistical models and historical data to estimate potential losses. One common metric is value at risk, or VAR.
VAR, yeah, that sounds familiar. Can you remind me how that works?
Sure, VAR is a statistical way to estimate how much a portfolio of assets could lose over a certain time at a certain confidence level.
Okay.
For example, let's say the VAR is $1 million at a 99% confidence level over one day.
Okay.
That means there's a 1% chance the portfolio could lose more than $1 million in a single day.
So it gives you an idea of that worst case scenario within a certain probability.
Exactly. But even though VAR is widely used, it's not perfect. It relies on past data and assumptions that might not always be true, especially when the market is super volatile or if something unexpected happens.
So it's a helpful tool, but not like a magic crystal ball.
You got it. That's why it's best to use VAR along with other risk management tools, like stress testing, where you look at how a portfolio might perform in different tough situations.
Makes sense. What about measuring those less tangible risks, like reputation or strategic risk? How do you put a number on those?
Yeah, those are trickier to quantify. It often involves making judgments and qualitative assessments, but there are tools and frameworks that can help.
Like what?
One common approach is a risk matrix. You basically assign a score to the likelihood and impact of each risk.
Yeah.
A reputation risk that's very likely and would have a huge impact would get a higher score than one that's unlikely and wouldn't have much impact.
So it's a way to rank risks based on how bad they could be.
Right. And then you can use that ranking to prioritize your risk management efforts. You focus on the ones that could cause the most damage.
It seems like the goal of quantifying risk, whether you're using fancy models or just making judgments, is to be more objective when making decisions?
Absolutely. It's about moving beyond gut feelings and using data and analysis to make smarter choices about managing risk.
This deep dive into risk management strategies and tools has been really insightful. As we wrap up, what are some final thoughts you want to leave with our listeners?
The biggest takeaway, I think, is that managing risk is an ongoing thing.
Yeah.
It never really ends. The types of risks out there and how big they are, it's constantly changing.
Right.
Organizations need to be flexible, proactive, and always thinking about risk.
So it's not like you make a risk management plan and then you're done. It's about always evaluating and adjusting as the world changes around you.
Exactly. When companies make risk management part of how they make decisions, they can not only avoid losses, but also find new opportunities and navigate all the complexity of today's world.
That's a great point. It's not just about protecting yourself. It's about using your understanding of risk to succeed.
Exactly. And as we move into a future with even more uncertainty and interconnectedness, mastering these risk management principles is going to be essential for success in any field.
Yeah, well said. And remember, risk is part of life. We can't escape it. But by being proactive, being informed, and managing it well, we can turn those potential problems into opportunities for growth.
Couldn't have said it better myself.
This has been an incredible journey, exploring all the pieces that make up risk management. We started by defining risk, looking at all its different forms, talk about strategies for dealing with it, even got into the tools and techniques for measuring risk and making better decisions.
It's been a great discussion.
It's clear that understanding and managing risk is crucial for anyone who wants to navigate today's world and achieve their goals.
I agree.
Thanks for joining us on this fascinating deep dive into the world of risk management. Until next time.